When it comes to building wealth, investing isn't just an option, it's a necessity. But once you decide to invest, the next question hits you. Should you be an active investor, constantly trying to beat the market? Or should you be a passive investor, content to match it? This debate, active versus passive, has been going on for decades. Both sides have strong arguments. Both have success stories. But at the end of the day, one strategy might align better with your goals, your psychology, and your long-term wealth plan. So today, we're going deep, not just scratching the surface. By the end of this video, you'll understand what each strategy truly means, how they work in practice, the real-world results they've delivered, and most importantly, which one works best for you. Understanding the core difference. Let's start with the basics. Active investing is all about beating the market. It means picking individual stocks, timing the market, and constantly buying and selling in pursuit of higher returns than an index like the S&P 500. Passive investing, on the other hand, is about matching the market. Instead of trying to outperform the index, you simply buy and hold it, through ETFs or index funds, and ride the overall growth of the market over time. Think of it like this. Active investors are like chefs crafting their own recipes, selecting each ingredient carefully to create something unique. Passive investors are like diners at a buffet. They take what's already been proven to work and enjoy steady results. Both have their appeal, but the outcomes, and the effort involved, are drastically different. The mindset behind each strategy. Before we dive into numbers and returns, let's talk about mindset. Active investing attracts people who love control, challenge, and analysis. It's the mindset of someone who says, "I can do better than average. I can beat the market." It's competitive, analytical, and sometimes a little ego-driven. Passive investing attracts people who think long-term, who believe time in the market beats timing the market. They're more focused on consistency than excitement. They see investing as a marathon, not a sprint. Neither mindset is wrong, but knowing your temperament is crucial. Because your personality will determine which strategy you'll actually stick with during market ups and downs. How active investing works. Let's break it down. An active investor studies financial statements, tracks market news, follows trends, and constantly rebalances their portfolio. They might buy Apple because they believe it's undervalued, sell Tesla because they think it's overhyped, or jump into a small-cap company because they expect a short-term surge. Active investors rely heavily on research, timing, and intuition. They may use technical analysis, studying charts and price patterns, or fundamental analysis, diving into balance sheets, cash flow, and earnings reports. Many also pay attention to macro trends, interest rates, inflation data, political shifts, even investor sentiment. Every decision is strategic. Every move is deliberate. But the challenge? You're competing against some of the smartest minds on Wall Street, professionals with teams of analysts, algorithms, and real-time data. For an individual investor, beating them consistently isn't easy. And even most professionals struggle to outperform the market year after year. How passive investing works. Now, let's flip to the other side. Passive investing takes a set it and forget it approach. You invest in a broad market index, like the S&P 500, NASDAQ 100, or a total market ETF, and simply hold it over the long term. Instead of constantly trading, you let your investments grow naturally with the market. You're not trying to pick winners and losers, you're betting on the overall progress of human innovation and capitalism. The philosophy is simple. Over time, markets go up. Yes, there are short-term crashes and dips, but long-term, the trend is upward. Passive investors rely on time and compounding, not timing or speculation. And the best part? It's cheap. Passive investing usually comes with very low fees because there's no need for constant trading or management. The power of compounding and time. Here's something most investors overlook. When you trade too often, like active investors do, you interrupt compounding. Compounding works best when money stays invested and keeps earning returns on returns. Every time you sell, You not only risk missing the next big move, but you also pay taxes and fees, both of which eat into your long-term gains. Passive investors, by staying invested, give compounding the time and space to work its magic. That's why someone who passively invests $10,000 a year into an index fund for 30 years could end up with well over $1 million, even with average market returns. Active investors might earn more some years, but they often trade that consistency for volatility and stress. The fee factor. Fees are the silent killer of wealth. Let's say you invest $100,000 for 30 years. If you earn an average of 8% annually and pay 1.5% in active management fees, your portfolio will grow to about $574,000. But if you instead use a passive index fund with a 0.05% fee, your portfolio could grow to about $940,000. That's nearly $366,000 more, just by paying lower fees. It's not just about returns, it's about how much you keep. Historical performance, what the data says. Now, let's look at hard evidence. Over the past few decades, study after study, from S&P Dow Jones indices to Morningstar, has shown that the majority of active fund managers fail to outperform the market over the long term. According to the SPIVA, S&P Indices versus Active scorecard, about 90% of actively managed funds underperform their benchmarks over a 20-year period. That means that if you just bought and held an index fund, you would have done better than 9 out of 10 active professionals. Why does this happen? Because markets are largely efficient. All available information, earnings, trends, and forecasts, gets priced in almost instantly. So by the time you react to a headline, the market has already moved. That's why Warren Buffett famously said, "A low-cost index fund is the most sensible investment for most people." And he backed it up. Buffett once bet a hedge fund manager $1 million that a simple S&P 500 index fund would outperform a portfolio of hedge funds over 10 years. The result? The index fund crushed the hedge funds. Passive investing won. The case for active investing. But let's be fair, active investing isn't all bad. There are valid reasons why some investors prefer it. First, flexibility. Active investors can adapt quickly to market conditions. If inflation rises or a company collapses, they can shift out instantly. Second, opportunity. In certain markets, especially emerging ones or under-researched sectors, skilled active investors can find mispriced assets and outperform. Third, personal involvement. For some people, investing actively is exciting. It's not just about money. It's about the thrill of making intelligent decisions, learning about businesses, and staying engaged with the economy. There are legendary investors who have built fortunes this way. Peter Lynch, George Soros, Cathie Wood, and Warren Buffett himself, though Buffett recommends passive investing for most people. The key difference? They dedicated their lives to understanding markets. They didn't treat investing like a hobby, it was their full-time obsession. The case for passive investing. Now, on the other hand, passive investing offers something extremely valuable: peace of mind. You don't have to constantly monitor the market. You don't have to stress about timing entries or exits. You simply buy, hold, and let the system work for you. Passive investing also eliminates emotional decision-making. Fear and greed, the two biggest enemies of investors, have no room to control your actions. When others panic and sell, you stay calm and keep your focus on the long game. And when you automate your investments, setting up regular contributions, you build wealth quietly and predictably. The psychology of long-term wealth. Investing isn't just about money, it's about mindset. The greatest investors aren't those who make the biggest short-term gains. They're the ones who master patience, consistency, and self-control. Passive investing trains these qualities. It rewards those who think in decades, not days. It aligns with how true wealth is built, quietly, consistently, and with conviction. Most people don't fail because they chose the wrong strategy. They fail because they didn't stick to their strategy. Final thoughts. The growth mindset approach. At the end of the day, investing isn't about being active or passive. It's about growth. Both strategies have something to teach you. Active investing teaches awareness, analysis, and adaptability. Passive investing teaches patience, discipline, and faith in long-term progress. When you adopt a growth mindset, you stop seeing them as opposites and start seeing them as tools. Your goal isn't to prove one right or wrong. Your goal is to understand yourself well enough to choose the strategy that lets you stay consistent and grow.